we live in a world of interdependencies. So you cannot outpace the rest of the world without at some point having the consequences of living in a bad neighborhood. I keep on reminding people how good your house is also a function of the neighborhood. And the global neighborhood is problematic because of what's happening in China, because of what's happening in Europe, and that spills over to the emerging world. So the hope is that we remain up here and the others start converging towards us over time. That is a healthy global economy. That is a global economy that can address common challenges. And there are going to be a lot of common challenges going forward.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Thank you for joining us for another Walker Webcast. It is my great pleasure to have my friend, Dr. Mohamed El-Erian, join me today. Mohamed came to Sun Valley for the Walker Dunlop Summer Conference last summer, and we published out on the Walker Webcast that face-to-face interview we did. And here we are 6 months later. A lot in our world has changed, and I am honored to have Dr. El-Erian back on the Walker Webcast. Mohamed, let me do a quick bio, not that it's needed for you, but just quick to remind some people of the perspective that you bring to my questions today, and then we'll dive into the conversation. Dr. Mohamed El-Erian is the president of Queen's College at Cambridge University. He serves as chief economic advisor at Allianz, the corporate parent of PIMCO, where he was chief executive and co-chief investment officer between 2007 and 2014. He is chair of Gramercy Fund Management. He is a columnist for Bloomberg Opinion and a contributing editor at the Financial Times. He's a professor of practice at Wharton and a senior global fellow at the Lauder Institute. He serves on 2 corporate boards and several advisory committees and nonprofit boards. Prior to PIMCO, Dr. El-Erian was a managing director at Salomon Smith Barney Citigroup in London. And before that, he spent 15 years at the International Monetary Fund in Washington, D.C., where he served as deputy director before moving to the private sector. He also spent 2 years as CEO and president of the Harvard Management Company. He's a graduate of Cambridge University and his master's and PhD from Oxford. So, Mohamed, I went back 2 years ago right now, and you were on CNBC and you said, quote, "I'm not in the camp that a recession is 100% probability, but I am in the camp that the probability of recession is uncomfortably high." And then you went on to say the probability of a soft landing is, quote, "meager." So here we are 2 years from then, and the uncomfortably high probability didn't happen, and seems to be that the meager outcome has actually happened. When we were together 6 months ago, you had a probability chart. It was wonderful. It was a multimodal distribution, which, as you described to all of us, is very difficult for humans to look at and sort of, if you will, not only analyze, but have conviction around. But on that chart, you had the chance of a recession at 35%, the chance of a soft landing at 50%, and the chance of a better than soft landing at about 15%. Where do you stand today on that distribution as it relates to the chances of recession, soft landing, or even better?
And thank you for having me. So the good news is the 35% probability of recession has not happened. And the 65% of something better is what has prevailed. What's even more interesting is that we really haven't had a soft landing. We've had a no landing. Growth has remained robust. Inflation has gotten sticky. So we're not back to the 2%. In fact, the Fed itself has acknowledged that once again, it has been confounded by what has happened to inflation. So we are living in this no landing scenario where growth is robust, hasn't reacted to what has been a significant increase in interest rates. Inflation has stopped coming down. The markets have repriced Fed cuts. The markets now only expect 1 to 2 cuts this year. We may get even less than that. So we are in this world of economic exceptionalism. And I say that because compared to Europe, compared to other countries, we are doing extremely well, and we continue to surprise on the upside.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
Let's dive in a little bit there on a number of things that you just said. So on the inflation being sticky, we've seen inflation come down. Last I heard you speak about this, you said that we're probably going to be at 2.5% to 3%, and that the Fed will be sort of accepting of that higher range. An area of inflation that's obviously very important to me and Walker & Dunlop and our clients is shelter. And it appears that with the oversupply in both single as well as multifamily in 2024 leading into 25, that prices have come down. Rent inflation, if you will, rents have come down. Single family housing prices have come down. Given the amount in the CPI that is shelter, if that continues to move down materially, isn't that going to get you below that target range that you said of 2.5 to 3?
And we'd hope so. I don't think we're going to get there. And I think more economists are recognizing that. Look, step back. The big bet was that we would get softer services inflation, softer housing inflation, while goods were outright in disinflation. And by the time goods reversed and started inflating again, because prices can't go down forever, then you would get to 2%. That was the big bet. It turns out that services in particularly are very sticky. And we continue to get indicators that the service sector is very strong. So you're not going to get enough disinflation from the service side before the goods side becomes less accommodating. That is the problem. Look, it's not an issue because, as you know, when we discussed this, I argued that if we were to establish an inflation target today, we wouldn't choose 2%. Structurally, we would go for a higher target of 2.5 to 3. 2.5 to 3 is fine. It's stable. It doesn't de-anchor inflation expectations. The problem is that the Fed cannot explicitly change its inflation target because it has missed it for so long. So the hope, and I hope that they do that, is they simply keep on pushing it back. Just keep on pushing it back, saying we'll get there eventually, and tolerate a somewhat higher inflation rate, because the alternative of hiking interest rates would be very bad news for the economy.
So there's just talking about hiking interest rates. I got something from JP Morgan. Michael Semblist is an incredible economist, and they sent this out. And in this analyst report called The Alchemist, which he put together at the end of the year, they looked at the 10-year Treasury 65 days after the first rate cut. And they looked at it in 7 examples. And in 5 of the 7, the 10-year was down 65 days after the first rate cut, somewhere between 40 and 60 basis points. In one instance in 2000, and I think it was in 1998, the 10-year had actually gone up by 10 basis points. But this time we're up 90 basis points. Holy, just, kind of off the charts as it relates to an anomaly. Talk for a moment, Mohamed, why we're getting this sort of, if you will, adverse or inverse reaction to rate cuts right now in the 10-year bond.
So part of it is initial conditions. We didn't start this from a normal situation. We started it from a situation where the Fed had been buying a lot of bonds. Interest rates were artificially low. And we had the combination of the Fed being late in raising interest rates, so having to raise interest rate really quickly, and QE, quantitative easing, when the Fed buys bonds and therefore puts downward pressure on yields, becoming QT, quantitative tightening, where they're reducing their balance sheet. So the initial conditions really were completely different. That's the first issue. The second issue is the economy has proven really strong. The economy has proven almost immune to rate hikes. Certain sectors, like yours, is not immune, but if you look at other sectors, it's done extremely well. And part of that is because corporations got ahead of the interest rate increases by pre-funding a lot of their needs. So that didn't hit. And then the third issue, it has to do with just the dynamics of inflation and the Fed not understanding the dynamics of inflation once again. So we have this very peculiar situation where the 10-year, like you said, has gone up. And I think that if we look for this year, it would not surprise me if for most of the year we average 4.75% to 5% for the 10-year, which would be quite high given that, like you said, historically, the 10-year goes down in a cutting cycle, doesn't go up.
And are you playing that, if that's your rate range, if you will, from 450, 475 to 5, is that slowing down the growth? Because if you think about it in the sense of PE multiples and where the market is, and we'll get to that in a second, are you playing that into that is going to put downward pressure on growth in the year, or where are you on GDP growth? Are you still at a 2.5 to 3% GDP growth for 25?
So I am where I was, but slightly lower on growth, the same where I was on inflation, but there was a big uncertainty. And that is the incoming Trump administration has signaled policy intentions in 3 areas. 1 is tariffs. 2 is repatriation of illegal immigrants and therefore a labor force issue. And 3 is on fiscal. So depending on where these things go, that's going to have a huge impact, especially on the inflation side of that equation.
And so talk about that for a second. I've heard you talk about sort of the 2 effects of the new administration coming in, where you have deregulation and growth on one side, and then you have a potential unsettling of the labor markets, and then tariffs on the other side. And you sort of have teed it up that there's sort of a, if you will, there's going to be a battle between those 2 things, and which one actually wins is going to have a big impact on the overall economy. Given the things you've seen and heard from the incoming administration, you think the growth and the deregulation efforts actually act to stimulate the economy more, or do you think that the tariffs and the labor disruption end up bringing it down where it's at net negative versus net positive?
Well, I think of it as a race. And if you ask me who's going to win the race at the end, it will be the deregulation, the liberalization, and what that does to productivity, what it does to growth. So if you ask me, think of it as a 400 meters, who's going to win the 400 meters race? In my mind, undoubtedly, it's the deregulation side. But in the first 100 meters, and maybe in the first 200 meters, depending on what happens on tariffs, the other side may be in the lead. So there's a time inconsistency aspect, because you cannot move as quickly on all that President Trump wants to do on the real economy as you can on tariffs. And I suspect that we will get tariff announcements pretty quickly. At the end of the day, and this is now me guessing because it really is a decision of one person, I suspect tariffs will be particularly problematic for China. They'll be less problematic for Europe and for Mexico and Canada. So, at the end of the day, countries will offer something to the Trump administration to make sure that we don't get a massive tariff shock.
Let's talk for a moment about deregulation, because there was a very interesting analysis that was done by the American Action Forum back in April, a gentleman named Doug Eakin, where they calculated the total cost of the final rules done by administration, from the Obama administration to the Trump administration to the Biden administration. And there were a couple stats, Mohamed, that just jumped out at me, which I think do speak to your point as it relates to the how the markets will react to the deregulation that is coming in from a Trump administration. The total cost of the final rules by administration, calculated by the American Action Forum, under Obama, $1.1 trillion. By Trump, $25 billion, and by Biden, $1.38 trillion. So Biden took the increased regulation from the Obama administration and took it to a whole different level as it relates to the cost of the rules that were put in place. And they also just getting heads around trillions of dollars of regulatory hurdles and burdens is a little difficult to do. They also calculated in paperwork hours. And I actually yesterday filled out my SEC board annual survey as it relates to any conflicts I might have. I'm assuming you've just done it for your 2 publicly traded boards recently. And, I'm sitting there with 30 pages of questions that go all over any possible conflict that I may have being on the board of Walker & Dunlop. But in paperwork hours calculated by millions of hours, the Obama administration rules added 240 million hours. The Trump administration last time 60 million. And the Biden administration, again, taking the Obama administration to a whole different level, 260 million hours of additional paperwork added by the rules that were passed by the Biden administration. So you've got to think that just any kind of reversion to where Trump was at somewhere in, I don't know what is that? That's less than 20% of the regulatory burden that was passed by the Obama administration and the Biden administration will be massively helpful to the overall markets, no?
That's how the markets have reacted. And it's not just the government. We're also seeing a change at the Federal Reserve where the market expects that this will unleash the banking sector even more. So certainly the markets are pricing in a significant impact on growth. And there's something else that you and I have talked about in the past, which is that we are seeing transformational changes in technology and life sciences. And then we're also seeing forced changes in defense, in healthcare. And those tend to have significant positive productivity effects. So if we can manage through the next 18 months, what comes thereafter is productivity enhancing and growth enhancing. But we've just got to manage through the next 18 months.
So I've heard you talk about change. I actually went back and watched the video you did on a TEDx speech you gave back in 2013, and you were talking about change in financial services and about the need for not necessarily to understand the why, but the what, in the sense of what are you going to do to change and get your organization ready for the type of change. Talk for a moment, because you've been in so many scaled organizations that have had to deal with not only changing markets, but the advent of new technology. Is today, Mohamed, in your view, wholly different from the technological changes that came in with the advent of the internet, the changes that came into the financial services markets back in the early 2012, 2013, over the last decade? Is this something that companies that you work with and see today, is this wholly different to the point where you literally have to stop everything and say, hold it, this is not the type of thing where you can just sort of evolve into the change, but you must dramatically change how you actually do what you do on a day-to-day basis?
Yeah, and you said the important word there, how. Most of the time it impacts what you do. This impacts how you do it. And in particular, artificial intelligence. I see this in education. I see it in health. We are just at the beginning of a fundamental change in how we do things. And the question I ask people when they say to me, well, how should I think about that? I say, ask yourself the following question. If I were born an AI native company, how would I be different? And force yourself. You're not going to become AI native. It takes a really long time. But force yourself to go through the thought exercise of how would you look if you were born AI native? If you didn't have all the legacy issues that we do, it's quite striking how different the world looks when you ask that question. And I do think that this transformation, which I do not believe is overhyped at all, is going to create leaders and laggards, and it's going to be fundamentally a different landscape in 5 to 10 years. I really do think that this is a structural break that's going on in the way we do things. And it's not just corporation, it is individuals, it is governments, and it also impacts how they react. And you heard me say it's the 80-20 80 is good, 20 is bad. And you shouldn't get carried away with either the 80 or the 20. You should embrace the 80 and the 20 and ask yourself, how do I unleash the 80 and how do I contain the 20? Because the 20 that is bad can be pretty bad.
I want to loop back to 80-20 in a second. I've got one other thing I want to talk about on AI before we go back to it, to talk about Europe and the US. But one of the things I thought was so interesting of you saying was, if you look at the way that the US is focused on AI, they're focused on the 80% of the good, and the EU is 100% focused on the 20% that is bad. And that's just showing you the investments and the returns that they're both going to get from it, which I thought was a very interesting. And we'll talk about Europe versus US exceptionalism in a second. But on AI, Mohamed, one of the things that a lot of people have been a little concerned about is the amount of CapEx investing that is going into data centers and the hyperscalers. The analysis that Semblus has in this JP Morgan report is that right now, with the CapEx spending of the hyperscalers, you could power 12,000 ChatGPTs. 12,000 ChatGPTs with the amount of capacity we have today in data centers for AI usage. So is there a chance, and he goes and talks about Corning at the turn of the millennium, and the fact that Corning at that time, when everyone was talking about broadband and fiber optics, that there was this massive investment in it, and Corning's revenues got to $4 billion in 2000, and that on real terms, Corning's revenues have never gotten back to $4 billion, and that they, since then, they just got oversupply of fiber optic networks, and therefore it's never actually caught up with the capacity we built. Do you at all get concerned that we're building too much capacity on the AI front right now?
Look, this overreaction is part of the process, and it's actually what makes this process a big enabler. You can look back at fiber optics. You can look back at securitization in finance. You can look back at the steam engine. The minute an innovation is perceived to lower the barriers to both producing it and using it, so whatever it is, you get overconsumption and overproduction. And that is part of the cycle of innovation, that you suddenly lower the barriers to entry for a certain activity. People rush in, that's what we do. There is excessive buying, there's excessive production, and then the system has a second round where it shakes off that. I would rather go through this than what's happening in Europe right now, which is very little. I think if you look at the cost benefit, it is much better to go in there. Look, you and I have discussed this in the past. What are the enablers of this AI revolution? One is data. There's a lot of data that is and being used. Two is expertise. Three is energy.
Right.
And four is computing power. Those are the four things that allow this. And are we going to have excesses? Sure we are. But at the end of the day, we will be in a better place than Europe and then China. And that's important because this is a transformational change.
So you mentioned energy. WTI crude is what closed yesterday at $74.22. That's the highest price in the last 3 months. So here we have an incoming administration that literally got elected on a theme of drill, drill, drill. And markets are supposed to look forward, not backwards. And so how is it, Mohamed, that we have WTI crude at $74 a barrel right now with an incoming administration that is looking to open up and produce more electricity in the United States? More, I should say, more oil, more natural gas, and derivatives from that over the next 4 years?
Two reasons. One is OPEC Plus is controlling supply, and Saudi Arabia in particular is producing well below capacity to protect price. But there's something else going on, which is geopolitics. If you're in the marketplace, you have to price in some probability, as low as it is, some probability of, and I'll give you a potential scenario. Right now, Iran has very few air defenses. Israel could be tempted to go after the nuclear facilities in Iran. There is a possibility, I'm not saying probability, a possibility that Iran responds by blocking the Straits of Hormuz. And next thing you know, oil is at 100 or 150. Now, is that a high probability event? No, but it's an impactful event. So there's this geopolitical cloud that's hanging over the energy market that results in a price that's much higher than what would be warranted by the demand side, because the demand side isn't that strong right now because of what's happening in China and what's happening in Europe. So for me, it's not surprising that between OPEC Plus controlling production and this geopolitical cloud that's still there, that we're seeing prices in the 70s.
It's interesting that you pointed out the shutting down of the straits, because I thought you were going to say, well, we could lose Iran's oil production if Israel were to invade them. But that's only 2 million barrels a day or something. So that's not going to move world prices. But to your point, if they were to do something to disrupt the trade of oil, that obviously has much broader implications than just Iran production coming offline.
Correct. And it's not that hard to block the straits, right? I mean, I remember it used to be talked about a lot in the past, and we've forgotten about it because this American exceptionalism has acted as a shield, as an incredible shield against very messy geopolitics. If you compare to when you and I discussed it in the summer, Russia has gotten an upper hand over Ukraine in that war. The conflict in the Middle East has continued and has spread. It has spread to Lebanon. It has spread to Iran. It has spread to Yemen. And we're seeing how fragile some of the countries out there are with what happened in Syria. So geopolitically, the situation has got messier than when we last spoke. And yet we've had this shield that has protected markets and has protected the economy from this messy geopolitics.
One other thing on energy before we go to U.S. exceptionalism. I've heard you say the good, the bad, and the ugly. Good U.S., bad Europe, and ugly. No, bad China, ugly Europe. I don't want to get to that in a second. But on energy, one of the other things that I've read, Mohamed, I'd love your thoughts on it, is just that we have increased oil production in the United States so dramatically that there isn't a huge amount of additional gains that can be had by this drill policy by the Trump administration. The numbers are that back from 2000 to 2010, we in the United States of crude natural gas and natural gas liquids were producing around 3 trillion BTUs per month. That then stepped up to 5 trillion BTUs per month from 14 to 18. And in 2024, we're producing 7 trillion BTUs per month. So our oil and natural gas production have just gone up so much. And then Biden's about to, I believe, sign an executive order that is going to ban drilling in the Atlantic as well as the Pacific. And it's one of those executive orders going back to the 1953 Outer Continental Shelf Agreement, something like that, that is going to be very difficult for Trump to come in and turn over. Do you think that's having some impact here? Or do you think that the Atlantic and the Pacific drilling is a minor issue as it relates to just the general Trump theme, and it's much more the global geopolitical issues than it is U.S. domestic oil policy and not being able to find increased returns?
I think it's more the global issues than the U.S. issues. I mean, it is incredible that the U.S. now is not only the major producer, but we have basically replaced Russia in LNG exports to Europe. Right. I mean, it is amazing how Europe is dependent now on U.S. LNG to replace what it lost in Russia. So if I look at the U.S. in the energy equation, it is totally dominant. And on balance, I expect it will become more dominant going forward. But we also have to deal with the fact that there are OPEC plus producers. You also have to deal with the fact that markets need to price something for a tail risk. You can't completely ignore a tail risk. So I think that's where we are. It is, for me, the most amazing side of the energy is the demand side. Because had people projected the weakness in Europe and the weakness in China, they would have projected much, much lower oil prices. Right. And it is striking that oil prices have remained there. And again, it's because of the supply side.
This summer, you spoke about the U.S. consumer and a concern over. I think you called it a K, where the
K-shaped economy.
yeah, a K-shaped economy where the low end falls and the upper end goes up, and so you're looking at averages that hold true, but it's distorted because there are fewer people who are driving the economy at the high end, and you're getting the lower going out. And that was all based off of sort of weakness in the credit markets and weakness with consumer demand. 6 months later, are you still concerned about that K-shaped economy, or do you think that the lower end is held up better than you had projected?
I'm still concerned. I mean, if you look at the debt numbers, at the credit card numbers, at the amount of savings that 50% of the population has, the lower end of the household segment is really under pressure, is significantly under pressure. And it played out in the elections that people simply have not felt the US exceptionalism. What they felt is the impact of inflation. What they felt is the pandemic savings being dwindling, disappearing. That's what they felt. Financial insecurity was a big theme in the election. So, yeah, I do worry. What has surprised me in a positive way is that it hasn't migrated up the income distribution, that it has remained concentrated in the lower segment. So I worry very much about them, but it hasn't impacted the averages, if you like, because it hasn't migrated up.
Super interesting. Let's talk about Europe, US, and China. When I went back and looked at that TEDx talk you gave in 2013, I also watched another interview you did in that same time frame, and it was interesting to see the emergence of China and China's economy becoming stronger than that of Japan. And we talked about Americans complaining about our unemployment rates and the stimulus not taking hold. And you talked about potential sovereign defaults in Europe, in Greece, that at that time had been, wholly sort of something that we never ever would thought that a sovereign could default in Europe. And here we are 13 years later, and we have incredible U.S. exceptionalism. And as I said previously, you have it played out that the good is the U.S., the bad is China, and the ugly is Europe. Talk for a moment. We've talked a bunch about U.S. exceptionalism. Talk for a moment about why China is so bad and why Europe is so ugly.
Well, let's start Europe being ugly. Europe has stopped investing in itself. It is not focused on productivity enhancing. It is not focused on the growth engines of tomorrow. And it is stuck in this low growth equilibrium. And when you get stuck in this low growth equilibrium, the probability of bad things happening is high. I'll give you an example. France lost its government. Next thing we know, the market risk assessment of French sovereign risk is the same as Greece. That was unthinkable. Europe is supposed to have the core, Germany, France, strong, solid, and then the periphery, weak. Now, suddenly, France from the core is being treated like Greece from the periphery. And that just gives you a sense of when you're not growing, you don't have the resilience to absorb shocks. And shocks happen. Political shocks happen. Geopolitical shocks happen. Social shocks happen. Economic shocks happen. So Europe is in this low growth equilibrium and now has lost leadership. Germany is about to have an election. France is pretty well without a government that can govern properly. And those are the two largest economies in Europe. So I really worry about Europe, that if it doesn't get its act together, it will fall further behind. And as it falls further behind, it will become more insular.
Talking about labor productivity, in this JP Morgan research report, they talk about the fact that you go back to 2017 and you put labor productivity in Europe and the US on par at 100. Labor productivity over that subsequent 7 years between 17 and 24. In the US, we've moved up to 118 on that scale. Mind you, they were both at 100, and Europe has only moved up to 103. So you look at this scale of labor productivity in the US is hard up to the upper right, and Europe just bops just just right along where it was back in 2017. And it's quite striking what has happened just from a labor productivity standpoint between the US and Europe.
Oh, absolutely. Now, imagine what that's going to look like as the US invests in tomorrow's engines of productivity and growth, and Europe gets stuck in yesterday's engines. It's going to get a lot bigger.
Yeah.
Ironically, Europe knows what to do. Mario Draghi, who was the president of the ECB, the European Central Bank, and then the Prime Minister of Italy, highly respected, did a report, a very good assessment of why it is that European competitiveness has eroded and what needs to happen. So this is not an engineering problem. This is a political implementation problem. It's a leadership problem. And until European politics improve, you're simply not going to get implementation of what you need. And I say that because the contrast with China is really striking. There, they know what they need to do. And in the past, they've been really good at course correcting. The way China has managed itself is it knows where it wants to be in 20 years' time. It knows what it needs to do the first 2 or 3 steps, and then it learns from its experience, it learns from others' experience, and course corrects. But in the last 5 years, we've seen very little course correction. Something has changed in the way the Chinese economy is managed. And now they're stuck between, on the one hand, facing enormous pressure to stimulate the old engine, and think of a car engine that is exhausted, that spills oil all over the place. So if you rev it up, you're going to end up having a lot of collateral damage and unintended consequences. But there's enormous pressure to rev it up to meet a 5% growth target. And on the other hand, is you have to completely rebuild the engine. And that means you have to sacrifice growth in the short term. And they've been looking at these two things, and literally they are paralyzed between the two and getting neither of them done. And that is why this notion of, is China investable, is China not investable, has become such a frequent topic of conversation among investors. And all this before you put in the geopolitics.
Right. I was just going to say, and that's pre-increase in tariffs.
Right.
So talking about the size of the U.S. economy, well, one of the things on Europe versus U.S., there was a neat chart in this report that they tracked 200 U.S. IPOs since 2000 and 50 European IPOs since 2000. And the cumulative market cap of those 200 U.S. IPOs is $18 trillion. And the cumulative market cap of those 50 European IPOs is less than $2 trillion. And you look at your point about investment in AI in the future and just the market value of those. But one of the things that I want to get your opinion of, Mohamed, is the dominance of the U.S. market. So if you go back to U.S. market cap in 2007, we had 42% of global market cap in the U.S. markets. Europe had 38%, and Japan had 10%. Okay, 2007. Now we fast forward to 2024. U.S. 70%, Europe 16%, Japan 7%. So Europe's fallen from 38% of global market cap down to 16% in 2024. Is this, we're clearly too big to fail, but do we get to a certain point where so much is coming to the US that it isn't good because we've lost the ability to grow? It's sort of back to that oil issue that I had there of, we've increased oil production so much that the relative returns that we can get out of more drilling in the United States, particularly if Biden closes off the Atlantic and the Pacific, might have diminishing returns to it. Do we have to see Europe and China get back going to get global GDP and our growth going? Or is it okay for US to be the belle of the ball for the next decade and continue to have all eyes, all investments coming to our shores?
So right now, there's a huge sucking sound, which we are sucking in capital from the rest of the world, and for good reasons. You make more money in the US. That is that simple. And because of that, the capitalization of US companies continues to go up, and the rest of the world continues to go down. And that seems great, with two important qualifications. One is that's a concentration issue here, that there's a few companies, as you know, that account for a lot of what's been happening. But the other thing is that we live in a world of interdependencies. So you cannot outpace the rest of the world without at some point having the consequences of living in a bad neighborhood. I keep on reminding people how good your house is also a function of the neighborhood. And the global neighborhood is problematic because of what's happening in China, because of what's happening in Europe, and that spills over to the emerging world. So the hope is that we remain up here and the others start converging towards us over time. That is a healthy global economy. That is a global economy that can address common challenges. And there are going to be a lot of common challenges going forward. The risk is we are up here and this goes back down. And at some point we get pulled down, like you point out. And we're not there yet. But that is the risk. So we actually have a significant interest in Europe in particular and China getting their act together and a number of emerging countries. We used to call it convergence, this notion that the less well-off will converge to the better off. We've seen divergence. And again, it's good if you are on the sunny side of the divergence, but at some point you've got to worry about the neighborhood.
In all eyes being on the US and that you're making more money here, obviously that means that people are buying dollars. That obviously has been extremely good for both the value of the dollar as well as the ability to sell our government debt. I want to talk about debt in a second, but as it relates to currency, one of the things you said this summer, Mohamed, that was very interesting to me was you said that China is building pipes around the dollar, that it's not that their currency is something that anyone actually wants to go out and buy. So it's not as if either the euro or the yuan is something as a holder of value that investors want to buy, but that China has set up a bunch of networks around the world that has basically bypassed the dollar. How much of a threat to the US dollar being the reserve currency are those actions by China?
Yeah, and I'm glad you brought it up. We have this incredible contrast. If you compare us to any other national currency, the dollar dominates. No one comes close to the role of the dollar in the system. If you compare us to non-national alternatives, gold, Bitcoin, suddenly the dollar doesn't look as strong. And that's because you've had these pipes being built around the dollar. So no one wants to replace the dollar as the reserve currency. No one. No one has the willingness or the ability to do so. So compare us to any other currency, we look great. However, countries are starting to say, well, can we operate outside the dollar system? And that's a lot of the interest in Bitcoin. Is the reason why central banks have bought more gold as part of their reserves in the last few years than they've had for a very, very long time, that are slowly diversifying away from the dollar. And then the question I get asked a lot when I go around the world is, how did Russia do it? Didn't you tell me, Mohammed, that when Russia gets kicked out of SWIFT, gets kicked out of the dollar system, its economy would collapse? Well, its economy seems to be doing quite well. It continues to trade. How does it do it without using the dollar? And what has happened is this very clunky, inefficient system involving at least 4 other currencies, none of which are the dollar, has emerged. It's very inefficient, but it works. And the worry for the US is that more countries will join that system. It's not going to replace the dollar anytime soon, but it is a threat over time.
I think it's your point about Russia is so interesting. The one thing I would point out there, as you well know, Mohammed, is the U.S. economy is a $29 trillion economy. Russia's economy is a $2 trillion economy. And I think a lot of people think of Russia because it's a superpower, that it's, that its economy actually kind of at one time was a competitive economy to the United States. It's not even, there are many states in the United States, actually 3 of them that are bigger than the economy of Russia. So I think that's something that people just, your point about them trading around us and their economy being able to trade even though they were kicked out of the SWIFT system is very, very relevant. At the same time, I think people do sometimes think that Russia is a much larger player on the global scale than they actually are. you mentioned Bitcoin. I went back, and this is the problem of being as widely watched as you are and having to talk all the time about projecting to the future, because you've been wildly prescient on many things. But 6 years ago, you were on CNBC when Bitcoin collapsed to $6,000 from $20,000 per coin, and you said, "I don't think it gets back to 20,000." And obviously, we're now a little bit beyond that. You also said at that time to Andrew, he was asking you the question, "Where do you buy?" And you said, "I'll buy at 5,000." And he said, "Why 5,000?" You said, "I don't know. It's a gut feeling." Did you actually buy Bitcoin when it got to 5,000, or do you not own Bitcoin?
So this is sad. So you're absolutely right. I was asked this when Bitcoin had gone first up to 20,000. And I was asked, would you buy it here? I said, no, look at the chart. It's ridiculous. It's very speculative. And then he said, where would you buy it? And I said, I would buy it below 5,000. And it went away. And quite a few months later, it was trading below 4,000. I felt compelled to buy. And I bought. And then over the next few months, it went back to 20,000. And this is a typical investment mistake, behavioral mistake, because 20,000 had become somehow my anchor, I sold at 20,000. And then I watched it go all the way up to 64,000, thinking I'm really silly. Then I saw it go back down, and now it's over 100,000. I say it to myself because when it comes to Bitcoin, which I didn't really understand, I did all the mistakes that you make, which is that you get anchored by some things that stick in your mind that are actually quite arbitrary in that. I do think where I still believe I'm right is that I never bought into it was fraud, it's going to disappear tomorrow. No, it is part of the payment system, the payments ecosystem, and it will remain part of that. But it will not be the global currency that people want it to be. It will be a commodity, if you like gold, that will be in more and more portfolios, up to 5-10%. It will be in certain payments, and it will exist in that world, but it's not going to replace the dollar. It will compete with the dollar at the margin, but it will not replace it.
Your comment there, Mohamed, about the investor's dilemma of where you got anchored at 20,000. It makes me think back to something I heard you talk about, the way that when you ran PIMCO, you had your investment committee, but then the investment committee, there were 3 other groups at PIMCO that were tasked with, if you will, testing and checking the assumptions that were being made by the investment committee, and that their job was literally to sit there and basically come in and try and tear apart all the theses that had been created for a certain investment. And I can't help but think that on that one of Bitcoin, had you had that, the 3 other groups probing at your assumptions as it relates to getting anchored at 20,000, that you might not have sold it at 20,000. Talk for a moment about how both beneficial that is and what you set up at PIMCO. But if someone's listening to this and saying, wow, whatever business, not necessarily a firm that is as global and as scaled as PIMCO, but what would you suggest to someone who's running their business as it relates to sort of just the challenging of certain assumptions of how you're running your business, how you're investing your dollars, and what's a good kind of best practice as it relates to testing those assumptions?
So you need to test them all the time, and especially so in today's world. I tell people, here's my baseline, but I'm testing my baseline every single day against data, because there are lots of uncertainties right now. The biggest trap, and you know that, you've avoided it really, really well, but lots of them have fallen hostage to that, is not to realize that things are changing around you. IBM learned that lesson with the PC, which it missed it completely. Kodak, of course, learned it in a big way. Nokia learned it in a big way. You're so successful that you believe that you're doing everything right, and you don't kick the tires often enough. And then suddenly you wake up to what's actually happening. So getting cognitive diversity, getting people to kick the tires for you, has to be wired into the system. You have to let structure do the heavy lifting. Otherwise, you won't do it. You literally will not do it. And that's sort of Bill Gross at PIMCO, he realized that you needed things like that. So you needed what's called shadow investment committees, whose role was to shadow the actual investment committee. You needed something that makes the whole firm go away once a year and look forward three to 5 years and get away from the day to day and try to take a view on which way is the highway going. Are we going east? Are we going west? We should know where we're going, because the day to day is what lane are you in and what cars are around you, but you better know where the highway is going. So the big sort of insight that I got from Bill, who did it so well, is use structure to do the heavy lifting, because otherwise you won't do it. And, the management gurus have this famous matrix of urgent and important. And we're very good at knowing what's urgent and important. We're also pretty good at knowing what's not urgent and what's not important. But what trips us up is that we often focus on the urgent and not important, and we don't focus on the important but not urgent. And the important and not urgent are the strategic issues. So you need structure to help you do that.
I think it's you. I've heard you before talk about two great analogies. One is the frog in the boiling pot. It doesn't feel like today is a time when many people are going to be the frog in the boiling pot, to the extent that AI is such a dramatic change in our world that everyone's sort of challenging their assumptions about it. It's not a time for complacency, which is what kills the frog that's sitting in the boiling pot. The other one that I loved was when you went back and used the Monty Python and the Holy Grail scene where the knight is sitting there and he gets his arm lopped off and he gets the other one and he keeps talking and he's like, "Oh, it's just a mere flesh wound." I laughed heartily on that one, Mohamed, because I thought it was so great. But it makes me think about what you just talked about testing the assumptions and what to drive towards. I think one of the big concerns that people have in this period of massive capex and investment is what happens all of a sudden if that 35% of your chart as it relates to hard landing all of a sudden comes about. As looping back to close this discussion out, as you think about the challenges that business leaders face today, of a new administration, of the geopolitical risk, of generally very positive economic indicators, yet seemingly significant risk. If you're sitting around the board table as you do often, is this generally speaking, do you have to be risk on right now? I guess is the easiest way for me to ask that question is, there are obviously always things that we're all thinking about and saying, oh, well, if I went and did that, the world could change. But you also said when we were together in July that you have to look at this bimodal chart and basically plan for everything. You can't just, our minds will go to the 65% probability of a 50% soft landing and the 15% that it's better, and we'll say 65%, go with that. And yet at the same time, to be a good investor, as you have been for so many years, you must keep in mind that there's that 35% capability. But that makes it very difficult to make actual binary decisions of invest, don't invest, go long, what have you. As you sit there today, is today a time to sit there and say, we move forward and we invest solidly? Or is now a time where it says the markets may have gotten ahead of all the things that are coming up in the new administration, the markets may have gotten ahead of US exceptionalism, and now is the time to be a little bit more tempered or cautious in what you're doing?
So it's easier for a financial investor than it is for a real investor, for someone who has to decide about plants and equipment and everything else, because you can be barbelled. I'll give you an example. You can have the safe element. You want it to be beta agnostic to the extent that it is. And these days you get paid a lot for it, unlike a few years ago. And then on the other side of the barbell is well-structured, risky investments. And that combination gives you the three things that you've heard me stress over and over. Resilience is the first one. This bit gives you resilience. 2, it gives you agility. As opportunity arises over here, you can redeploy from here to here. And 3, because you've got these two things there in front of you, you've got to have a broad mindset. You can't just focus on, oh, I'm risk averse, oh, I'm risk loving. No, it's a combination. I've got to be a combination of both. So I tell people, always ask yourself the question, do you structurally have resilience? Do you structurally have agility? And do you structurally have optionality? Because those are the three things that pay off in the world that we live in today.
You have lots of optionality in what you do with your time. And I'm deeply thankful of you spending an hour with me to talk about the markets and the world that we live in today. It's great to see you at the beginning of the new year. And I am certain that everyone who will listen to this will gain a lot as it relates to their outlook and thoughts about what is happening in our world, what's happening in the US, Europe, China, the new administration, and all the economic indicators, if you will, that you've discussed in such clarity today. And I'm just deeply thankful of spending an hour with me, Mohamed, and our friendship.
No, I thank you, and thank you for the friendship, and thank you for the really interesting conversation. It scares me that you go back all the time. And Happy New Year to you, and Happy New Year to everybody listening to this.
Greatly appreciate it, Mohamed. Have a wonderful day.
You too. Bye-bye.
Take care. Bye-bye.